Welcome to Securities Lending Saturday with yet another technical glitch. There's always something every week. Welcome to live broadcasting with me, Roy Zimmerhansl, your host today. We're going to be talking about securities lending, the chicken and egg conundrum when it comes to emerging markets. So if you're part of the securities lending infrastructure, be it as an institutional investor, a retail participant, or the intermediaries and service providers that make this market happen, or if you're just interested to learn more about it, then this is the place for you. So let's get to it. As I said, we're going to be talking about emerging markets, securities lending, supply demand, and the chicken and egg. So let me get my slide deck up. There we go. I'm stuck in the corner again. Good morning, Lewis. Really happy to see you here again. Hope everything's going well with your constant innovation in the marketplace. Glad to see you with us today again. So this is what we're going to be talking about today. A quick recap on what we've been doing so far. The last few weeks, we've been talking about emerging markets. So in the first week, it was motivation. Why do markets bring in securities lending and short selling? Last week, it was about some of the infrastructure issues that emerging markets need to address when they're considering whether to go into securities lending or not, or short selling, right? And whether there's enabling legislation and regulation that facilitates that, or whether they need to address it. So we talked about 3 themes, but 8 topics. Feel free to go back to that. I'll actually leave a link in the video notes here. And next week, because we're already in November, we've seen the Q3 performance numbers starting to come out over the last couple of weeks. And so next week, I'm going to take you through the figures and we'll see what that actually means. Right. This is part 25. We have been doing this now for 26 weeks. So those of you that have been with me for some, all, or part of the journey, thank you very much for your time and attention. It's a half year. We had 1 week off with technical problems that we couldn't overcome, unlike the technical problems that we've had today, where we were able to overcome them. So I'm pretty excited about that. I'm pumped. That's half a year where we've been sharing information with the wider global community, and this is a pervasive market. And one of the things I'm going to be talking about later in today's presentation is the markets that I see that are undersized and have a lot of potential to grow. So stick with it until we get to that. This is what we'll be talking about today. So the long and short investors and their objectives in terms of doing emerging markets and securities lending, the conundrum that we face when looking at new markets, and the economics of a trade. I'm then going to look at it, just a sample market. I'm going to talk about Korea, how it became one of the mainstays of revenue generation in the business, and some of the lessons learned there. And then I'm going to talk about, as I said, markets that I think have potential. So that's what we're going to be talking about today. As always, we really appreciate if you give us a thumbs up or up thumb. I hear people describe it differently, or a like, depending on whichever platform that you're on. And if you want to subscribe, that would be great. I'd love to have more subscribers. In fact, I'm on a bit of a drive right now. We're trying to get to 500 subscribers. And the reason we've picked that magic number of 500 is that you get the opportunity when you reach 500 to open up the community tab on YouTube. And by opening up the community tab, that means it'll be a free format place for debate, discussion, asking questions, create more of a community there. Now, we already do weekly blog posts. I run a LinkedIn group that has not quite 6,000 members in there, where people have the opportunity to ask questions, raise issues, share information. And I run a private members club for securities lending market participants as well. And there's a forum in there where we post lots of stories and people ask questions. And that's great. But each of those is very limited. So if you're not on LinkedIn, well, you can't get access to that. If you're not of a mind to join the membership club, of course, you don't get access to that information. But we want to share stuff. The information on our website, the blogs and that, they're all free. But we think that what we're trying to do with this whole venture is to reach the widest possible community of people and engage more and share more information and knowledge and answer questions about securities lending. So to me, the YouTube community tab is a real goal. The minimum number of subscribers used to be 1,000. They've dropped that to 500. So we're about 160 away from that. So I'd like your help. If you like these videos, if you think that they're useful, please subscribe and recommend it to clients, colleagues, friends, anyone that's really going to subscribe, but get value out of it. Only if you get value out of it. I don't want people just to subscribe for the sake of it. So help me get that done, and it will benefit everyone because we'll have a new place where we can share information. Okay, let me bring up my slides again and we'll get back to it. Let's get to this. So as usual, we're going to be doing 10 minutes. We cut the stream to 10 minutes on LinkedIn. So live, if you're watching it on LinkedIn, then that's great. You'll see the whole show, nothing to worry about. If you are looking at this on replay, you'll only see the first 10 minutes. So I'm going to cut this momentarily in the actual replay that will be available on LinkedIn. And then tomorrow on Sunday afternoon UK time, about 3 p.m., then you'll be able to see the full edited video where I add a few other things into the videos usually, and that'll be available on our YouTube channel, which I'll bring up in a second. But so that's what the gig is. Of course, I'm still in a dispute with Facebook because they have allocated my securities lending copyright material to somehow to the ownership of a cricket club. So, who knows? Maybe I'll ask Mark Zuckerberg next time I'm chatting with him why they've done that. But anyway, it is what it is. So let's talk about just quickly a review of the previous two sessions. So the first one we were talking about, why do emerging markets even want securities lending and short selling as part of their markets? It does four things. Number one, it adds liquidity. More traders that trade long and short means more activity. More activity means more turnover, which means more liquidity. By having short sellers in the market, you get more opinions on the value of securities. You have more analysis, more research, more views being shared. And so from that perspective, it's more likely to generate a fair price at that given point in time. The third reason they do that is for the ability to support. So securities lending, short selling often support other products like exchange traded funds, ETFs. So if an emerging market wants to see domestically listed ETFs, then having securities lending there helps those ETFs generate incremental return or reduce costs because different funds approach it differently. So it supports ETFs. For derivative markets, of course, there's often hedges involved that are required in the cash markets. And so without short selling and securities lending, you couldn't execute those hedges. So having securities lending and short selling in a marketplace encourages the growth of other products. And then the final point, what I explained in the video, and we'll have links for all of this stuff in the show notes. But what happens with short sellers as markets are going up and up and up, eventually short sellers go, this looks like it's a little bit too high. So rather than just a straight line up, it moderates it with a little bit of more short selling activity. So the market doesn't quite go to the same lengths that it otherwise would have. And that's good because it does take some of the froth off the market, allows people to reset, rethink, should this market really be going up this high? Should this stock really be at the price that it's at? And short sellers give that pause that refreshes. On the downside, of course, short sellers jump in as markets start to fall and crash, and they help accelerate it, build the momentum, and create further downfalls possibly. But on the other hand, they're the only ones that are buying often. As you get markets crash, for them to book profits, they have to buy back. Whereas what a long investor does, they just need to outperform their peer group. And if all of their peer group is still selling, they'll keep selling. And so short sellers also moderate the troughs. Markets don't fall as low as they otherwise would because you have this naturally inbuilt buyers, because the difference between a long seller and a short seller is a short seller has on the back end, they have to buy it back. A long seller might never buy that stock again. Okay, so those are the 4 reasons. If we then look at the second part of it, the infrastructure issues, as I said, there's 3 categories: legal and tax issues. So you need to be certain what the legal treatment of securities lending activities are, what happens in the event of an insolvency, and you also, of course, need to know what the impact is from a tax perspective. And there's 4 or 5 taxes that you need to be aware of before deciding to do securities lending in a given market. There's the transaction structure. So you're talking about cash markets, physical markets. You're talking about different ways of doing it, and the structures, the participation, and the transaction. These trades can be set up in multiple different ways, and it's not always obvious to outside observers. So I suggest you go back and look at that, because I don't really want to cover ground we've already covered. And then, of course, participation is really the key thing. And we'll see this with the Korea example later, but the fewer barriers there are, the more effective both short selling and securities lending is in terms of achieving these 4 goals that I talked about previously. So participation is key. And we'll talk a little bit about participation today as well. Now, let's just have a quick review of entering a new market for long investors. Look for them. Their goals are they're going into emerging markets because they think they will outperform. So this is performance driven. At the very least, it's about diversification. It's about diversification of your portfolio holdings, where your assets are invested, and the degree to which there's correlation between that emerging market and the rest of your portfolio. So it's really about performance. And of course, the securities lending aspect specifically is about generating incremental returns on that portfolio. And maybe that's just about returns, or maybe it's to offset cost, because emerging markets tend to have higher processing costs, lower scale, less activity, perhaps less investment over the years. And so the unit processing costs are often higher. So securities lending revenue can often defray the costs of participating in that new market. And of course, what a lender wants is, securities lending, I've said many times, is basic economics. It's economics 101, supply and demand. And so what a lender wants to do is, in this emerging market, if they're the first or second or third lender in there, they want to leverage the scarcity value of their supply into generating those incremental returns. But of course, as with anything, it's not just about the goals, what you want out of it. There's also challenges. And look, I talked in the last slide about all of the infrastructure issues which you need to be aware of before you go into a market. So it is complicated to get into a new market. There's lots of things you need to check and satisfy yourself. And then what do you do if it's not quite 100%? Do you go or do you wait? So securities lending, new markets, there's a lot of layers that need to be looked into. And of course, there's, as the saying goes, the earliest pioneers get the most arrows. Innovation is a challenge, right? Because there's no guarantee that you'll be successful. And that uncertainty really is what I suppose puts a lot of people off. One of the reasons why people don't go into new markets more quickly is because they want to see somebody else do it. And once somebody else has done it and been successful, well, maybe now they'll feel a little bit more comfortable. So the biggest challenge for me, I think, is about this kind of innovation and uncertainty. That doesn't always sit well with people as individuals or organizations. And certainly those organizations going into the new markets, their primary concern is the welfare of their investors, so they don't want to take chances with other people's money. And just like scarcity value can be an opportunity in terms of generating revenue, it's also a bit of a challenge, because remember, if I make a loan and I need that stock back, my borrower needs to get that stock back to me. And so their first stopping point is to borrow it from somebody else. If I'm the only lender, where are they going to get it from? They can't. So what they have to do is go into the market. So that scarcity value also adds a layer of challenge and uncertainty into the program. So pro and con on the same issue. Now, if we look at the short side of the investment equation, again, let's look at their objectives and goals. Clearly, they're all about performance-driven decisions. And now, one thing which I keep stressing every time I talk about short selling is that a short seller typically doesn't just go short in a market unless they're a dedicated short bias fund where all they do is take short positions. Most funds will have long positions and short positions and then skew them differently based on their outlook overall. And so by enabling short selling, you're also likely to bring in more inward long investing as well. And so a short seller or a fund that can do both long and short investing might see that going into a new market will give them an advantage for performance in that market because they can go both long and short if they can borrow the securities. Clearly, it's about generating the incremental returns and offsetting costs in the same way as everything else. And again, it's about leveraging that scarcity value, but even up a level from that, because now it's not just about being an investor long that you have scarcity value on. You might be in an even smaller number of shorts investors, and so might have an edge there as well. So that's the good side of it. Of course, the challenge is it's even more complex because they're working on both sides of the investing spectrum. And there's additional regulation and compliance requirements, possibly, and different processes involved in doing those executions. It is much more complex for short investors. And clearly, they need for the short side to be executed, whether it's a physical cash market transaction or a synthetic with their prime broker, they need to be able to access the supply, or their prime broker needs to access the supply. Of course, prime brokers also have the potential that if they might have two clients, one who wants to go long in a stock and the other one who wants to go short in that same stock, they can offset it, internally by internalizing that. So they might not need to hit the cash market if that's permitted for the marketplace in question, or they might find other synthetic providers, but usually along the way somewhere, there needs to be a cash market transaction somewhere. So supply is really critical to this. And clearly, their opportunity and their focus and their ambition even suffers because of the scarcity value. And I'll talk about that in a moment. So, look, there's goals for both long and short investors in this equation. And so that's how we end up with this supply and conundrum where the lenders are saying, I'll lend to you once you commit to me that you have a reason to borrow, that you're going to borrow my shares. I have a lot of work and a lot of preparation and a lot of due diligence and a lot of analysis and a lot of money I have to sink into a new market before I'll feel comfortable lending. Whereas the hedge fund might say, look, I'm not even going to look at developing these trading strategies unless I know that there's going to be securities that are available for me to borrow. So this is your chicken and egg situation. Who's going to move first? And that's the $64,000 or whatever the right currency and amount is to quote these days. But let me give you a real life example of how we actually face this. And I'll use South Korea. So it was a big market. For many investors, South Korea was their second largest Asian market after Japan, right? So it was they already had quite large values of holdings in their portfolio. So when you're looking at lending opportunities, this isn't like I've got $5 million in an emerging market. I've got 100 million, I've got 200 million, I have 500 million or more. So it made sense to say, if this market can be successful, then there's a lot of money in it. Okay, so that was the starting point. Now, if you just give me a moment, my voice is starting to go. So I will go to my Coke break. Hold on, the pause that refreshes. Big market, lots of holdings by value. And all of a sudden it became a lendable market. And so how did we get over this issue? I will lend it once you tell me you're going to borrow it, versus I'll start developing my trading strategies when you tell me I can borrow from you. And so what actually solved the case was exclusives, where what we did as intermediaries, whether you were a prime broker or an agent lender, we would go to the investors that held these securities and say, if you give me as a borrower exclusive access to your portfolio for a period of 1 year, I will guarantee you a minimum amount of money that will allow you to go into this market with some confidence. It will subsidize and give you certainty that the money you sink in terms of investment analysis, research, tax, legals, all of that isn't going to be wasted money because you're going to be guaranteed to get this minimum level from me. And because the portfolios were big values, this was big money. In my blog post that I wrote about this topic, a couple of months ago, it was in the millions. We were bidding millions of dollars in exclusive. So even if we didn't borrow a stock, we'd still be on the hook for the millions. Of course, we did our best. And that was the experience. So year one, we spent millions, literally millions, enabling these portfolios, bringing them to our hedge fund clients saying, see, you wanted stock, we got you stock. And everyone's happy. Maybe not. Because what we discovered was that although investors had big value holdings in South Korea, they weren't particularly diverse holdings. They all held the same 20 stocks or most of the same 20 stocks. And the main index, it was either 100 stocks or 200 stocks, depending on which one you want to look at. So having 20 stocks or 25 stocks, that's not a very good proxy for the marketplace. And in fact, even worse, the biggest holding in each of these, in almost everyone's portfolio, was Samsung. And it could be 40%, 50% of their holdings. So half of the money that we were giving was going to a stock that we could already borrow in ADR form in the US. So we learned a lot of lessons in year one. Year two, when those exclusives expired and we rebid on them, then all of a sudden the rates went down, but they were still measured in the millions. For a few years, we put a lot of money into this, but it really greased the wheels. Investors said, oh, okay, agent lender, you tell me it's okay and I'm willing to do it. Agent lender said, yeah, we know we're going to get a big chunk of that guaranteed money. And the risk was by the prime brokers. Now, of course, the difference then was that was really at the beginning of this century. In the 90s was an incredibly profitable growth cycle for the prime brokerage business. And so people were still having an appetite to invest in the market, really, because revenues were growing faster than expenses. And so it was still okay. That kind of fell away. When you start sinking a few million for no return, that gets your attention real quick. So it muddled along for a few years, but over time, what we then saw was there were more domestic Korean institutions involved on the long side where they said, look, I'll have some of that. And it's great when domestic investors start to participate in their domestic market lending activity because they have deeper pools of assets and also more stable pools. So they hold more stocks in a market and they hold them for longer. And so that's also a good thing from a borrower's point of view. I know that I can now look at a bigger universe of stocks potentially to borrow, and I don't have to worry about the scarcity of being recalled. Of course, you do as with your normal market dynamics on specials and hard to borrow stocks, but in general, the universe opened up. But in addition to institutional investors becoming lenders, you also had domestic hedge funds springing up, domestic prime brokers. And what ended up being created was domestic long and short activity, adding to the cross-border long and short activity. So you ended up with a very successful marketplace where there were firms in Korea, outside of Korea, as both borrowers and lenders. And that was a very successful use case. Now, of course, the period we're talking about here is over a decade. Okay, so that's a long time. And to be honest with you, I don't really see in the foreseeable future anyone stepping up and saying, I'll pay $3 million, $4 million, $5 million for exclusive access to a portfolio in a new market. Now, China opens up, if India opens up, maybe that might change. I might change my view. But right now, I don't see anyone committing that kind of money. But I'd love to be proven wrong because that's the thing that really made South Korea so successful. Now, in terms of markets where there's potential, where is this, right? What are the new markets we're talking about? Well, I've looked at both corporate bonds here on the left and equity stock exchanges on the right-hand side. If you look at the global corporate bond market, there is one market there that completely stands out. And that's the number two market, which is circled in red, or there's a rectangle in red, or whatever shape you want to call that. That's the Chinese corporate bond market. And that is huge, right? Second only to the US. So that, despite whatever activity might be happening domestically, cross-border activity focused on this market would be huge. Now, look, we've all seen the activity with Evergrande over the last month. Arguably, Evergrande's been on everyone's radar screen for years, but it's really come home to roost. And there's been real sort of interest from people looking at this and say, hey, what's the outlook for other Chinese corporates? So if China opened up at some point, that's a potentially huge. So on the right-hand side, what you have is all of the equity markets where short selling, I think, is either not available or it's not to the size that it should be. So number one would be China. And number six, there you see India, where there is domestic market activity, but really short selling is constrained primarily to domestic short sellers. So foreigners can lend into the market, but not be short sellers very easily. Saudi Arabia does allow it now, but it's still early days. And in any case, you've been able to get short exposure to Saudi Arabia in the form of a swap. So you have been able to do that. I would see it as growing. So to me, Saudi Arabia is a market where there is activity, but it has plenty of room to grow. Iran, number 12. I found that one really interesting. That was a real outlier for me. It might be the one market where I have literally zero comment on, but you can see the potential size of it there. Brazil, you can do it today via futures contracts. You have been able to do it for a long time, but it still isn't very friendly for non-resident participants. So I think there's room to grow. It'd be the last market I talk about, but not everyone's lending in Russia today. At HSBC, where I was in my last job, we were lending in Russia, I think in 2015. So you can see the range of views where we were comfortable doing it then, but even today, some lenders aren't lending it. So all of those markets there have potential to either introduce it for the first time or extend activity beyond what they're doing today. So you can see why I'm so excited, because there is so much potential opportunity there. And also the reason I'm doing this, there will be people in each of those markets that will be involved in securities lending next year or 2 years from now or 3 years from now that need to learn about securities lending. And I'm hoping that they'll be able to source information here to learn more about it. I just want to take you through one example, because you can say, Roy, this, presumably this scarcity value will create good returns. And in theory, that's true. But let me just walk you through this. If you think of a typical stock loan transaction in an emerging market, it's probably going to be valued between $100,000 and $250,000 in absolute value. That's roughly a quarter of your typical stock loan transaction, which is worth $1 million. But don't get me started on averages. I'll just skip that. So you've got a $250,000 loan, and it's at a fairly high fee, which is 200 basis points or 2% per annum. But look, practically, that only generates $13 in fee accruals every day. And at an 80-20 fee split, that means that the agent lender is only getting $2 a day, $2.74. And if you think of the settlement costs, which the agents absorb, I've put in $10 here, and that's one delivery out to the borrower and one return at some point. Often you'll see securities lending transactions have more. A short seller might borrow a security and return part of it and then return the rest of it. All right. So you might see in that transaction maybe 3 transactions. So you could have quite a wide number of trades generating additional costs. And so even if you say there's only 2, and even if you say the cost is $10 per trade, and it's probably higher, that means that they're absorbing $20 of cost, which means it takes 7 days of that trade being outstanding just to break. And so that's on a per transaction cost. And it takes lots of 7 days worth of fees at $2.74 to make up for the cost of the due diligence, the research, the analysis, the legal fees, all of the costs of getting into it. Let me just say hello to Ali. Thanks very much for joining me today, and thanks for your comment there. And look, I encourage everyone to look up Ali and his business, which is Hansuki Consulting. They have some top-notch events coming up and have produced them in the past on tax and the tax and financial markets, and they really are mandatory viewing for any professional in this marketplace, and they're free to join, so make the most of it. Okay, so look, that's the transaction level challenge. You can see why people are pretty hesitant to say, I'll just build it. I'll just do the research. I'll just do the analysis. I'll just get everything set up, and hopefully the trades will come. That's a pretty expensive business, right? This isn't, as I said before, this isn't the 90s where revenues just went up and up, and it didn't matter what your costs were because your revenues always outpaced your expenses. That's not the world that we live in today. I hope all that's been interesting to you. If you want to learn more about this stuff, I have a few of my courses. I have the free course, the primer on securities lending. We also have a free primer on repo, the introduction to financial markets and the role of securities lending. I'm almost done recording that. I've had another busy week, so I will hopefully get to that soon. And then you got the big mama, the introduction to securities lending course, the 8 lessons, the review lesson, and the exam. So that's the big kahuna of securities lending courses, and that's what turns you into a viewer, into an expert. Let me just summarize where we are. What we talked about today was the long-short investors and their objectives. There's definitely an alignment of their objectives, but also on the challenges side. Both of them are looking at performance to be a differentiator for them. Both of them recognize the opportunities and the risks that scarcity brings to participating in securities lending and short selling in emerging markets. The conundrum that we faced, I'm not going to do it until you do your bit. You do your bit first, and then I'll come in. If 2 parties say that, it's a challenge. So build it and they will come just isn't viable today. And so something's got to break the ice. And the message I want to leave you all with is there are solutions for all of this. We've helped people go into these new markets in the early days to break that conundrum by matching up the investor with the short seller. And so we have solutions, but it's just not easy. But it is worthwhile. We talked about the example of Korea being a big success story, but of course, that took a long period of time, and it was with considerable investment and risk, and not everyone really got the return on the money that they invested in it. So a challenge, an interesting story, not necessarily a blueprint for today or tomorrow, though. And then, of course, there are a number of markets on the equity side where there's potential for growth in the future, and then one really huge bond market being the corporate bond market in China. So there's lots of markets with lots of opportunities there. And so that's it. Next week, we're going to do part 26. We're going to be talking about the third quarter market review. So we're going to look at revenues. We're going to look at balances. We're going to see what's been happening in the last quarter and what is the outlook for next week. That's it for me. I hope you have a great Saturday. I hope you have a great weekend. I hope you have a fantastic week, and I look forward to seeing you next Sunday. Thanks, and